Okay, I think we got a good amount here. Jess, if you want to kick
All
it
right,
off.
I'll get started. Good afternoon, everyone. Thanks for joining us today for the second session in building the building blocks of personal finance. Today, we'll be covering aspects of insurance and the age-old debate of renting versus buying a home. Again, we are going to be, the session is being recorded. While we're getting started here, please continue to add to the chat, who you are, where you're calling from, what you do, what you're interested in learning, anything else you think is relevant. Great to get a little conversation going. We will be doing a breakout room after Erik does his presentation, and we'll give you some prompts for that part of the event and to discuss with each other and then report back to the larger group. It's a fun activity we've done in the past. If you can all just keep yourselves on mute, that'd be helpful, unless we ask you to unmute when you have a Q&A, a question in the Q&A session. And I'll jump in now and give you a little bit of background on Kettle Space, and then we'll hand it over to Erik. So Kettle Space, we are a real estate technology company. We're based in New York City. We have a network of inspiring workspaces and a passion for community development. Since the pandemic, we've been partnering with organizations to help them bring their people back to the office with a variety of flexible workspace options. And our goal has always been to support, empower, and connect our community. And that is why we are here today producing these events and many others like them. I am excited to introduce you to a member of our community and the host for today's event, Erik Cooper. Erik has worked in mortgage banking, sales, trading, and wealth management. He started his firm ELC Advisors to provide the same financial advice to his clients that wealthy insiders know. Thank you again for joining us today. Erik, the floor is yours.
Thank you so much. Thank everyone for joining. Again, please, yes, I did get a new haircut, buzzed it off. I'm in Arizona. It's 80 degrees here most days now, so it's my summer due. Excited to have you guys here. Again, please drop questions in chat because I like to ad lib more than I like to present. But we are next phase of personal finance, the building blocks. Today, we'll talk a little about insurance and renting versus buying. Who am I? Just another idiot from Wall Street who thought he could start his own firm and did it. Why is that important to you? Because I generally talk about this stuff all day long. I think last time we started in this lower, Mac, if you could share this presentation so people have it too. I think I sent it to you. We started this lower band, kind of the goals of thinking about money, our balance sheet, how to budget, different type of budgeting ideas, and thinking about debt. Today, we're briefly going to talk about kind of all the types of insurance. So at this second level, and then the age-old debate of renting versus buying. I like to joke this slide that I'm showing you here is kind of the Maslow's hierarchy of needs of personal finance. You got to get this boring stuff at the bottom right before you can kind of start thinking about the other things. And then as you move on, you actually have excess money you're looking to invest. Then it becomes, okay, how much can I invest? What are the right type of account structures? What are the things I should be doing? So today we're going to focus on kind of insurance, protecting yourself, and then renting versus buying. Again, feel free to jump in with any questions. Let's see. So what do you need to do? So when I think about protecting yourself, and insurance is like number one line of defense is having an emergency fund. You need to be able to take care of expenses. Most people, 50% of Americans, can't handle a $400 or $500 expense. So you really need to think about what your budget looks like. The tires blow, you have an unexpected emergency room visit, like you have to have that emergency expense. If you are part of the people who get some of that, the new stimulus coming through, yes, stimulate the economy. When it starts opening up, get some good meals. But first thing you should do is think about adding to your emergency fund, okay? Next, well, you can't rent a home. So this is probably a moot point for most people, so we'll go fast. But you can't rent or buy a home, at least with a mortgage, without usually some sort of insurance. But make sure you're protected and you have adequate coverage, because God forbid, your house burns down and you cheaped out on it, and now you can't even rebuild your house, but you're still underwater on your mortgage. Same thing if you live in an apartment. If you don't have adequate coverage, something floods, you need to make sure you can cover all new clothes and all new furniture. God forbid something crazy happens. And, you know, you go, well, that's kind of a ridiculous thing. Well, I lived in Texas for a lot of my adult life, and we just saw as everything just froze and pipes burst, thousands of people now needed to replace all of their belongings because their pipes burst. So it's not, I know it's maybe an act of God, but these things do happen. And we just witnessed it in Texas. So just make sure you have the right levels of coverage. Okay, so there are all sorts of life insurance. There are term, which I think is the only type you should use. There's variable life, there's whole life, there's annuities. But what I would say, ignore all those and just use term life insurance. It is way, way cheaper. And you only need term life insurance if you have beneficiaries or heirs that you're worried about. If you're a single young professional and there's no one to worry about, you don't even need term insurance. But if you have someone that you have to take care of and think about, kids, a spouse, then you should really consider term insurance. Another easy way, a nice way to think about term insurance, what you should be doing is if you have kids, let's say you want to buy a $500,000 policy and you have 2 kids because you want to make sure they're protected. Well, instead of buying one $500,000 policy, that's a 20-year term that starts to get a little bit expensive, or $1 million policy, you can get a 10-year term. So if your kids are 5, once they hit 15, maybe there's less need for insurance going forward. So, and then you could get another 20-year term. So if you wanted a $500,000 total coverage, do 10 years at $250K, and then $250K at 20-year term. So you can really reduce some of your insurance expense moving forward. But I would recommend just term insurance. I know this is another hot topic that you could debate for hours, and there are a lot of insurance salespeople, but I kind of adhere to insurance is sold, not bought, and a lot of bad insurance is sold, not bought, because it's very fee laden. Other types of insurance that aren't term kind of mix investments along with insurance. It becomes very opaque and it becomes very expensive very quickly. So at the very least, yes, if you want to look at a variable life or whole life or some sort of annuity, just make sure you're digging into the details. I know I've been working in finance for 20 years and I don't understand the details, so that's why I tend to avoid it. Okay, so let's say you've accumulated assets. This one's real simple. You need a will. You don't want the state to decide what's going to happen with your assets. And you're saying, well, that's not true. By default, your assets will go into probate, and a state and a judge will determine what happened to your assets. So make sure you are protecting yourself with a will. It can be simple. You can go to LegalZoom. You can go to a friend attorney, and it just has to get notarized. But it's a super simple and cheap step to make sure, whatever you've worked to accumulate, it's going where you want to. So again, I've always thought about money, begin with the end in mind. I know it's a little dark feeling, and especially a time of COVID when you've experienced a lot of death and things are going on, but understand what you want to happen to your assets and your estate. You've probably been working your tail off for all this stuff. So make some decisions now while you can direct what's going to happen. Unfortunately, I've experienced a few deaths this past week, and the states, one was in order and one was not. And, if you do a favor to your friends and family and your heirs and just take some stress off of them, even though it feels weird to do it now. So sorry to be dark, but got to do it. Same thing with if you want a DNR, your healthcare directive or a living will. Look, if you've had a good life and you, God forbid, have a stroke or heart attack, and be like, look, I'm 60 years old. I don't care. I don't want to come out of it because I know my life is going to be kind of terrible if I've had all sorts of surgeries and whatever, and you want a DNR, make sure it's communicated. Or if you think I'm in amazing shape, I'm going to live to 120, I'm doing every age-defying thing, make sure it's communicated to your heirs and your family, the people around you. Put it in writing. Estate plan, same thing. Once you've accumulated some assets, make sure this is similar to will. This goes kind of above and beyond a will if you have more assets, but make sure you can do different types of trust to make sure the money is directed exactly where you want it. You can keep these things out of probate if you want to establish some sort of trust. That way, I don't know if people know, but when you pass away, things go through probate. Even if you have a will, it all becomes public record. So if you don't want your neighbor to know that you've hated for years exactly what kind of money you had and who got it, just make sure you do some other sort of estate planning. If you're gone and you don't care, no big deal. All right, health insurance. We probably all have some exposure and need it via Obamacare or the Affordable Care Act, or if you're on Medicare, a lot of these things are potentially getting expanded on the new administration. But make sure that you're doing the right thing by, first of all, covering yourself, but secondly, contributing to HSA. So I would say a big takeaway from today is make sure imagine I have technically good insurance, but I have a high deductible plan that comes with a HSA. So not only do I save for it, one of the big takeaways from today is to make sure you have an asset allocation and investment options included in your HSA. Some people probably, they have some money deducted, they throw it in there, whatever the max is a year, a few $1,000s, and then it just sits there in cash. Well, this HSA from a financial standpoint is kind of a secret, triple secret tax-free account. You get tax-free contributions, so you can deduct it from your income. The growth accumulates tax-free, and then as long as you're using it in health-related expenses, it's tax-free when you use it. So, but here's the one thing you don't want to do. You don't want to contribute a whole bunch of money through your 20s, 30s, and 40s into your HSA, and it was just sitting in cash and not keeping up with inflation. We know education and healthcare expenses are the most inflationary kind of segments of the economy. So you want to make sure you're keeping up with growth in your HSA, right? So make sure there will be investment options that you're getting some equity exposure in your health savings account, and you go in there and you'll probably find a bond fund, an equity fund. Make sure you're doing, look, if you need the money within the next year, don't get equity exposure. But if you're 30 years old contributing to an HSA and you're probably going to need this money, yeah, maybe in a few years, you're going to have things that come up, but more than likely your healthcare expenses are going to kind of go to the moon when you're in your 60s and 70s. Make sure you're getting equity exposure in an account to keep up with inflation of healthcare expenses.
Eric,
Okay.
you might have already said this, but can you just redefine kind of what an HSA is and where to find it? We just had a question in the chat.
Yep. So HSA is a health savings account. Typically, there's some sort. It could be provided by your employer or some sponsor plan, or if you are going through the Affordable Care Act or Obamacare, you establish an HSA on a high deductible plan. If you have like the Cadillac of all insurance and your employer covers everything, you may not be eligible. If you have low premiums and it's not a high deductible plan and you're under, but generally if you're under a high deductible health insurance plan, which a lot of people opt into just because your premiums are so much lower, you will have access to a health savings account. So make sure you're doing your homework on there, make sure you're contributing, and make sure you're selecting some investment options inside that health savings account. I'm just looking at the Q&A here. Thoughts about having 2 life insurance policies, one for your beneficiaries, another for emergencies that you can sell while you're alive. One for the beneficiaries, absolutely. Kind of figuring out expense matching. If you know your annual income covers X amount of mortgage, this, that, whatever, multiply that out by 10 years. That's what your policy should be, the amount of your life insurance. The other about selling it while you're alive, I think I would just not pay a premium and try to sell that. And I know there's a secondary market for life insurance policies, but they basically take a really big haircut and now they want you to die so they can get their money. So that just feels like it has unintended consequences in that market. And it seems a little funky to me. So yes, one for your beneficiaries. Trying to game the secondary market of buying a life insurance policy and selling it in a secondary market is a little bit funky to me. Any other questions on insurance or health savings account before I get to the tried and true age-old debate of renting versus buying?
Oh yeah, we actually had one other question in the chat. Catherine, do you want to if you're available, do you want to go on mic and ask your question?
Oh, I just had some questions, because the interest rate are sort of low right now. If you have some recommendations for online savings account versus money market.
Yeah,
and
sure.
that.
I think a few that I would, this is not a plug for Goldman because I don't care about them, but Marcus from Goldman Sachs has one. I'll put these in. Capital One 360 has a decent one. I think Discover Bank has a decent online. I would literally Google, you can go to Nerd Wallet. I think they might review all these. Let me put this in there.
What are we looking for though, exactly?
You're
Like,
literally Googling online savings account.
okay, I've done that. And then I guess they can usually have like a table that compares like how much you have to put down at first and then interest. Like how do I
On
decide
the
what's
online
right for
savings
me?
account, you want to look for an account that has no fees and no minimums.
Okay.
Typically the reason you want to stay away from like a brick and mortar, if you're going to a Wells Fargo or Bank of America, they typically have minimums on their accounts, and they pay effectively zero interest, no matter what the environment is. So you always want, if you have a few $1,000s or tens of thousands of dollars and you don't want to invest it and you need it in some finite period, the online savings account is definitely the way to go.
Okay, great. Thank you.
Sure thing. Okay, and with that, we will hop into rent versus buy, which is super fun and everyone's best topic. All right, so I don't have a dog in a fight, except that I want people to think more than they do about this. So I feel like we are often sold the American dream of, oh, you got to buy a house because that's what you do. That's how you save money. A house is a good investment. I would take the other side of the argument. And by the way, I've bought several houses in my life and own a house now. Okay. So I'm not saying you should never do it, but I'm saying a lot of thought, more thought than we put into it in one of our biggest, it's usually our biggest financial transaction ever. We put more than a house than we put in retirement, savings, cars, anything else. It is our biggest financial transaction that we ever engage in our life. And we all just go, oh, okay, I'll go on Zillow and look around. And this seems interesting. Instead of saying, wait, do I need to be buying? Do I even want a house? Do I want the associated expenses? Does it make sense financially? Have I actually compared apples to apples, or am I comparing apples and oranges? And I know it's different by market. If you're in New York City versus San Francisco versus Iowa, yeah, always buy in Iowa. But if you live in San Francisco, it might not make sense. If you live in New York City, it might not make sense. So my only thing here is a thought exercise to say, hey, have you actually done the due diligence to do the homework to understand what your expenses will be? So I just did a simple example here. The biggest one, when you sell a house, a realtor gets paid 6% of your fees. And as a seller, you pay that. As a buyer, you don't pay that, but that gets baked into the price. So typically what happens, you engage a real estate agent, you sell a house for $500,000, 6% comes off the top. 6%, that's $30,000. That 6% gets split between each agent. So the buyer's agent gets $15,000, the seller's agent gets $15,000. That agent usually splits that commission with their broker half and half. So they got $7,500 for opening and closing doors and giving you some paperwork. I'm not bashing on real estate agents. I'm just giving you the economics of understanding what that is. So maybe it would actually be cheaper if you want to buy a house to go get your realtor's license for $500 and then act as your own agent. That's a hack in the system that you could save yourself $20,000. And people are like, that's not true. That's not possible. Yeah, you can write your own real estate contract pretty easily. So again, not bashing on the profession. Like if you're buying a house across the country, which I've done before, they are incredible. They know markets, they know areas. They can kind of give you the inside baseball, what's happening, what the neighbors are doing. Like, I think they can add a lot of value, but I also think you need to make sure one of the biggest expenses you'll ever pay is to real estate agents. So that's off the top. Also note, you'll have to pay for title insurance. You will have to pay annual maintenance of 1% a year. So if you have a $500,000 house, I apologize if that's over or under what everyone is ever talking about. If it's a $200,000 house, perfect, that too. But 1% is the kind of general amount that you should budget in for annual maintenance. So $500,000 house, that's $5,000 a year that you're not even thinking about. Property taxes, homeowners insurance, your down payment, right? The beat goes on and on and on. So many people get to closing, and again, I worked in mortgage banking, and they go, all right, I'm so excited, I'm gonna sign my document, blah, blah, blah. And about a day or maybe 48 hours before, you get the final closing doc, the HUD one, and they say, okay, your down payment was $50,000, and then here are all your closing fees and everything else, and you got to bring an extra $7,000, and you're going, wait, what? The amount of deals that get scrambled, or people have to raise money at the last one because they're just not taking in all the expenses, versus you can rent an apartment, something goes wrong, you just walk away, you're done. So I just want to give this some thought. I put this lovely spreadsheet together. Let me put this in chat too. You can go in, this is because I'm a mortgage banking finance nerd. What I've done is I just put together an amortization table where you can see what have I actually paid. So what I do know by Mortgage Bankers Association, doing a little research, the average person stays in their house about 8 years. Okay, so in my example here, I'm saying $500,000 house, you put $100,000 down. So you have a $400,000 mortgage, and in our friendly, I guess I didn't copy over, but in a mortgage rate environment that's been friendly of late, call it 4%, right? Well, you're like, okay, I'm doing all of the right things in the world. Well, let me tell you what, after 8 years, the point at which you might go and sell a house, you've only paid down $65,000 in principal. You still owe $334,000 in principal. You've paid $118,000 in interest, because the way mortgage finance works, they front load all the interest. So you think you're doing all the right things, but you're paying so little interest, it may not make sense. And the only reason I'm saying all that is walking through it is mortgage finance, they're really smart. They're going to get their money up front. You think you're building equity, you're sold the American dream, the home is an investment. I'm just saying it may not be the case if you're not going to be there for longer than 7, 8, 10, 15 years, and most people aren't. So I just think you need to reframe as home as consumption and not investment. So with that, I'll hand it back. And if you guys want to handle breakout groups, someone pick a side, go ahead and argue rent versus buy. You can do your breakout groups, and then you guys can come back bloodied and bruised, and then we can reconvene.
Eric, before we go to that, just a quick question. As a homeowner myself, interest deductions, and that changed a few years ago. You want to touch on that, or?
So the
tax deduction.
So it used to be better, right?
Yeah, it used to be better.
Yeah, so people are like, oh, but I'm getting 30 cents on the dollar back. Are you? What I would say about the interest deductions is it's gotten worse over the years. But the other thing is, don't let the tax tail wag the dog. So people are like, oh, I'm getting this. Like, people do all these mental gymnastics. The fact that you even brought that up, like, oh, but I'm getting an interest deduction, that's got to be worth X on this. Is it? Have you put it in the spreadsheet and actually gone line item by line item to see, oh, I could have rented the equivalent house and been ahead. So again, this isn't to bash fully on buying. I keep buying houses because I'm also an idiot. But I've also rented for stretches, and I also had the thought of like, oh man, that light bulb's out. I just get to call the maintenance people. That is incredible. And the last apartment I lived in, it wasn't an app. I didn't even talk to anybody. So anyway, I think just food for thought.
Everyone likes that idea of getting a tax deduction. Sounds good.
Yeah, right.
All right. So before we break out into breakout rooms, a couple of notes. We're going to do Q&A right afterwards. So the way this will work is Mac will break us all into small little groups. Please make sure you have your video on so everyone can see each other's smiling faces. Do a quick introduction around the room. If you choose one person from the room to represent, and then we'll come back at the end, and that person can share their insights, feedback on what the group thought about. And you'll be discussing the pros and cons of renting. Should you keep renting? Is renting better than buying? Should you purchase a home? Is buying the better choice? Based on everything Erik just went over. And Mac will set you all up. It should be fun. Have some fun. This isn't school. It's supposed to be fun, and make a new connection while you're in there.
I would like everyone to come back with an enemy. I'd like someone to take either side and tell them why they're an idiot.
Awesome. Okay. So I'm going to open these rooms. We're going to be in there for like about 7 or 10 minutes. And you can always reach out to me if you have any issues. Just put it in the chat, and I'll be looking for that. Okay. So without further ado, I'm going to open these rooms, and you can go ahead and join. All right. So everyone should see a, okay, awesome. Go ahead and join those.
They're prompted to join, right?
Yep, you should see a button. Let me know if you don't see that. All right. Excellent.
Erik, there's a question about, oh, you got it. Never mind.
Yeah, the other question I saw, and I don't know if everyone can still hear me when they're joining breakout.
Nah.
No, they can't.
No, I think they're in their own little rooms.
Okay.
Okay.
Yeah.
Just like moving people around so they have somebody to talk to. There you go. Okay.
Erik, I have a good question for you for when we come back to the Q&A.
Uh-oh.
Oh, I think it's a good question. You may
Give them a challenge. I like how you. Oh, wait, actually, never mind. I'll save it for afterwards.
Mac, I see there's 2 people still waiting to.
Okay. Let's see. Okay, let me get this. There we go. 3. Okay. Yeah, there's a couple people that just, might just be logged off or like not paying attention. But if you are, and you're just coming back, we just opened breakout rooms. You should see a button to join one of these breakout rooms. We're discussing the pros and cons of renting versus buying. And we're going to jump back in and discuss the pros and cons.
How many rooms did you do, Mac?
I did 3. Because it's, a lot of people aren't
Didn't join?
aren't participating. Yeah. Actually, that's not true. Fair amount of people are.
People coming back here, looks like.
Okay.
I think some folks are popping back in here. Looks like.
Hey, Jessa. Do you have to leave soon?
I do. I have to head out, unfortunately.
Okay.
But,
No worries.
thank you, everyone.
No problem. Thanks for joining.
Yeah,
You'll
bye
get the
for now.
recording. Bye-bye. Okay.
So Mac, did you post? Do you have the ability to post the question into the breakout rooms just to remind them?
Yeah. Do that again. Oh yeah, broadcast message. Oh. And I should probably jump in there just to see how things are going. Renting versus buying.
There's Erik, I don't know if you saw this question that's in the chat. Can you think of home purchases as more of an investment if you pay all up front?
I saw that one, and then another one on with rates way down and refinancing.
Financing, yeah. Personally, I'd still be renting an apartment if it was up to me. I grew up in an apartment. I would be renting an apartment.
I think marriage changes a lot of it.
That's what I said. If it was up to me.
Right, because it's up to me, I'd be renting an apartment.
That's a nice
Hey guys,
apartment.
I'm just gonna join the groups really quick.
Yeah, go for it.
Yeah.
I joke, I'm like, why is this a man's responsibility? I don't want to do yard work. I don't want to do this.
The yard work, the fixing, you
Yeah.
know, there's always something. I was telling Mac right before this, I had the gutters had to get cleaned, and the guy he found a problem. So of course, something that was going to be, relatively inexpensive, all of a sudden, it was $50 more than you thought it was. That's a small example, but you've been there. You probably.
Oh, 2 months after buying this house, we bought this summer. Literally, it was like a pandemic buy. The water main broke. Like I got a crazy water bill that was like, I don't know, $300. It should have been $60 or something. Like, what the hell is going on? And I kind of searched the property, and I live up on a hill. I spent 3 hours digging out. I found the break in the water main, and then the plumber came, and it should have taken them 2 hours to fix it. It took them like 5 hours. So I was working side by side with a plumber all day long one day. Like, homeowners are the worst.
Yeah, that's water main break is not something you want.
No.
I get every month. It seems like every month. Maybe it's not as frequent. The water company sends sewage insurance, so you can protect, like if they have to dig up your lawn to replace the main. It's like never stops.
That's all. That's like the your car warranty policy's out. You want to update that? I'm like, no, I don't.
Yeah, it's basically for $300 you could avoid $10,000 of expenses. So.
Right. Outside of life insurance, I tend to be a self-insurer.
Yeah, some of these things just like you said.
You can insure yourself at death, right?
1% of the cost of the value of your house. Probably a good number to use.
Yeah.
Mac is back. Mac, I think some other folks popped in again, but you want to give them another minute? What do you want to do there? You're on mute.
Hey, good conversations happening there. I will broadcast 1 more minute on the breakout rooms. Cool.
So you know the room orders, so maybe you could just call, spokesperson from room 1, 2, 3, or however they're identified.
Right. That's a good point. All right. So we got 1, 3, and 5. 1, 3, and 5. 1,
right.
3, and 5. Okay.
Going with the odd numbering today. Fine. It's good.
I'll bring back in 1 minute. Okay, and then I will believe. Okay. 1, 3, and 5. Yeah, Anita. And okay. Good stuff. Yeah, it seems like people are just talking about. I heard one woman talking about she's a farmer, and I think she's renting. There's some interesting situations that people are discussing in there.
It's good. So you're bringing them back. It seems like. Yeah.
30 seconds.
Welcome back, everyone.
Back, guys. Gonna let everyone jump back in here, and then if I'm just gonna, or Joseph will be calling on, or actually I'll be calling on representatives of each group just to kind of share what you guys discussed, and then Erik can kind of get into the specifics with you guys. Hopefully that was good exercise.
Hopefully everyone enjoyed the conversation.
Yeah. We don't want it all to be Mr. Erik.
Especially since I don't know what I'm talking about.
Well, 'cause you keep buying houses.
I know, no one should listen to me. You guys know me as this expert. I don't know what I'm doing here.
All right, so Mac, is everyone back?
Everyone is back.
All right.
Okay. Thanks for jumping in there. So if group 1, I don't know if you remember which group, so that's the group with Rhea in it. Do you want to, I don't know who your spokesperson is, but do you want to jump in and kind of share what you guys talked about? Let's see. Group 1, who else did you guys
Sure.
have? Yeah, there you are.
We all kind of shared experiences. We live in different parts of the country. So like I'm from California, and for me, I bought a house when I was 23. I rented out the bedrooms. I lived in the garage. I just had other people pay my mortgage. When I sold it, I sold it just under the amount so that I didn't have to pay capital gains tax. And so for me, that was a good way to make some passive income and kind of recoup the money that I would get from paying rent otherwise. But for people in New York, there are so many fees and prices are higher, and there are a lot more restrictions on what you can and can't do. So in some cases, it makes more sense to rent if you don't want to spend the time dealing with repairs, or you don't want to hold liability if you're trying to do other things with your money, then it makes more sense to pursue something different. And yeah, I'm sure there's more. If anybody else wants to chime in.
Yeah, feel free if anyone else in the group want to share anything.
By the way, that's a great life hack that sounds like, you made a little bit of a sacrifice. I don't know how nice your garage was that you lived in or not, but that's like the tried and true, that passive wealth of buying a house and having 2 or 3 roommates pay for a mortgage is an incredible strategy if that's something you're willing to do. So good job. Very good forethought there.
Awesome. Okay, if no one else from that group wants to share, I'll move on to the next group. Group number 3, that was Anita was in there. I don't know if you guys chose a spokesperson, but do you want to share what you talked about?
Jim is our spokesperson.
Okay, Jim.
Yeah, hi everyone. So we went back and forth in discussing some of the pros and cons. And one of the things we discovered is on this spreadsheet, we didn't know where that tax deduction came out to and what the savings per month would be, and then how that affects the calculus to buy. I know Erik said that it shouldn't affect it that much. But we also discussed market strength, and some markets are just very hard to get into. And there might always be some level of growth, which might make a high price perhaps worth it. That being said, the 20% to put down could be, all of your savings. So how do you do the cost benefit analysis of, putting your savings all in one place, with also the need, for example, for an emergency fund or something like that. So those were kind of the issues we discussed.
Excellent. Thanks for sharing. Erik, any thoughts right off the bat?
Yeah, so I apologize for not thinking about the tax deduction on a mortgage, but hopefully you have the edit. You can kind of plug that in there, and I can also update and share back with the guys. But your point is very well heard on, okay, does eat up the down payment of 25%. If you want to avoid PMI, private mortgage insurance, insurance sounds like a benefit for you. It's not, it's just a benefit for the lender. So if you default on your mortgage, the lender still gets paid and the mortgage-backed security gets funded to the retiree, to the pension fund who bought it. So you always want to put at least the minimum down to not have to pay private mortgage insurance, because that further increases your monthly expense. But the one thing I'd say, let's see, this slide. So kind of the way to think about it, instead of putting that $100,000 down, you could invest that. And then in 10 years time, I just assumed a 9% return. The market's probably returns closer to 11, 10 or 11 over a 40-year window. I know those could be aggressive, so I made a table here. You can pick your time frame, your rate of return in a number of years, but I just said 9% growing at 10 years, that $100,000 could potentially, again, there's market risk. We might have another Great Depression at some point, but at 9% a year compounded without ever adding another dollar could turn into $237,000. So that's just another way from a comparison standpoint to look, okay, is my real estate going to grow? Real estate grows a little ahead inflation. So 3%, 4% a year. Again, this is all very market specific. If you were in San Francisco going into this pandemic, your real estate prices have just collapsed. But if you just bought at this bottom in San Francisco or New York City, probably the next 10 years, as we get this whole mess behind us, it's probably going to be a decent run. I have the hypothesis we're going to turn into the roaring 20s. So we've seen asset inflation, bonds. So that's why interest rates are so low, because bond prices are expensive and the Fed is setting rates low. We've seen equities, so stocks go near all-time highs every day, but that's not necessarily because of earnings have increased. There's been a price earnings multiple expansion. Now we have cryptocurrency all-time highs. We have non-fungible tokens and digital art selling for $69 million. So there's just been inflation in every single asset class. And we've seen it too with housing. So lumber is up 50, 60% to buy a new house. It's adding a ton of expense to build. So your point is heard. It's market specific, and it is a store of value. So I don't know if the real estate continues to grow at a long-term average of 3 to 4% versus the market at 10. So the idea is, what arbitrage game are you trying to play? Again, I think of housing as consumption, but it's also a decent store of value after you factor in all the expenses. Sorry, that was a long-winded answer.
This is Ria. I just wanted to throw in there too that I used the 2% FHA down payment plan to buy my house. So I actually didn't put a lot of capital up front. So, I put like 5,000 down and then had other people paying all the money, right? So that's another thing to just kind of throw in there. Yeah,
you should be teaching this class or running this session. You figured out every correct way to do it as far as minimizing house expense while maximizing return. That's incredible. Well done.
She's going to teach the buying the house class, not the rent versus buy class.
Awesome. Thanks for that. Is anyone else from the group?
Prepaying mortgage. I think prepaying mortgage is good. You're just building on equity in your house, but that'll be a return further down the road. And again, I think that's a great way of kind of forced savings. The other, if you don't need the money, I would consider investing at a rate of return. So if you're prepaying your mortgage, let's say your mortgage is 4%, are you missing out on 8% returns in the market? So that's the arbitrage. You're missing out on a 4%. Me personally, I pay down debt. I pay down mortgage. I don't like it. I hate debt. And I work in finance as a financial advisor and a wealth management guy. So I know that I'm missing out on, let's call it, I could have a 3% mortgage and make 10% of the market. I'm missing out on 7% a year on a fairly sizable amount of money. But for me, it becomes a risk management and a sleep well at night. I'm already exposed to the markets plenty. Yeah, okay, so I didn't grow my extra couple $100,000 at 7%. So what? You're not taking my house away from me. I feel good about it. It's a stupid financial decision. It's a great emotional decision for me.
Awesome. Okay, and the final group that had Chow was in that. I'm not sure if I'm pronouncing that right. Do you guys want to share? Did you pick a representative? by any chance? Final group. Does anyone want to share from that group?
They agreed with everything everyone else said.
Yeah, I think there was no argument there. Okay. Well, we are running a little short on time, so we can just move on to our regular
So
Q&A and just open it. Yeah.
Yeah, we can jump into the Q&A. Mac, I know there were a couple of questions that Eric didn't get to, but
I'll chime in right away. There's one on refinance. Yes. Refinance if you're going to be in the house for another 5, 6, 7 years. If you're at a 6% interest rate and you can now get 3.5%, but just make sure your closing costs and the refinance savings doesn't exceed the amount of monthly savings based on the amount of time that you're going to be there. So if you refinance and then let's say you come out of pocket and closing costs, they don't roll all your closing costs in and you're out of pocket $2,500 and you're only saving $200 a month. Well, you can do the quick math to realize you got to be there for a certain amount of time before you can even recoup, before you hit your break even. But we are at all-time lows in interest rates effectively. I know they're bouncing back up now of mortgage rates. One of the best ways, and this is financial arbitrage that I'm not very comfortable with. I just said, I like the emotional comfort of paying down your mortgage. But if you're worried about inflation, you should go out and get the biggest mortgage you can on the biggest house you can afford. This is true. And because now you're going to have a fixed 3% rate. And if you're worried about inflation, your money, the growth in money supply will inflate your way out of the mortgage interest that you owe, because salaries will go up, property values will go up, and you'll still be adhering to that fixed payment at a 3% rate. So that's not great financial advice, but that is a game that people play. And if you think inflation is going to run away just because they printed another $1.9 trillion that got out to the people, and you think that's a concern, then take a big mortgage, a big loan to value mortgage, and let the inflation pay your mortgage over time effectively.
And buy some sleeping pills to help you sleep.
Yeah, right. That's not a game I like to play, but that's a game that can be played.
Are there any other questions in the chat that we missed? Does anyone else have any questions they'd like to ask Eric? Now is a good time. You can unmute yourself if you'd like to ask. While people are thinking, Eric, I have a question or a statement. I'll figure out how it comes out. From something you said earlier in the presentation about insurance and young people not needing insurance. What do you think about people buying insurance to ensure that they are insurable later in life? Because when you're young, you're healthy. When you get older, sometimes.
That's a great point. Yes, especially on a term insurance. I think there's a pretty big, a significant jump if you're a man, I'm not sure women, but after the age of 40 as a man, and even like after the age of 30 as a man, I've looked at these rates or whatever over time, where you go, whoa, that's a big jump. It's just like, and then it causes you to confront your mortality. You go, oh, I'm more expensive insured now because I'm closer to death. So that's a weird kind of self-thought to have. But yes, insuring a little bit earlier in life to make sure you are insurable and your premiums will be lower. I think that actually makes some good sense.
Yeah, I mean, there are definitely people who are completely healthy in their 20s and 30s, and then things happen. Life gets in the way.
A family, kids, a significant other, spouse, partner, and you want to do it pre-40 is definitely the way to do it.
Excellent. Appreciate that. Anyone else? Final call for questions. There's one in the chat.
I had a quick questions I reposted in the chat, but I've heard of this thing of buying 2 life insurance policies, one for like your beneficiaries and one that, as you grow older, you could possibly sell as an asset. I was wondering what's the process you need to understand if that's viable for oneself?
Yeah, I touched on it, I thought earlier a little bit. One for beneficiaries, absolutely. So you really want a liability expense match. So if you have kids that have college tuition and you're the sole earner, or even if you're not, if you have a stay-at-home partner, childcare is very expensive. So you need to put that, like if your husband or wife dies, and let's say your husband passes away and he's the primary child caretaker, well, that now costs you $30, $40, $50,000 a year to take care of your kids. And if you're the woman, you better make sure your husband was covered with a policy, because you might have it through work and your husband didn't have one. So I think it makes sense to cover everyone appropriately. So yes, about your beneficiaries and expense liability matching, what you actually need, college educations, paying off mortgage, et cetera, et cetera. I said earlier on the other one, having another one to sell, it's basically you're trying to arbitrage the market. So people can get annuities and then you can sell them into a secondary market. So there's brokers, and you may see there's some stupid insurance commercial that has a stupid jingle that's on CNBC, and it's something catchy, but it drives me nuts. But it's basically a secondary market where they're going to pay you 30, 40, maybe 50 cents on the dollar to take that premium off your hands, that life insurance policy. Now they want you to die. So I think I said it before, there's kind of like perverse incentives in that market, and they're doing it at a huge discount. So what I would say to that is just save more money. If it's just for your heirs, or for your benefit, if it's for someone else, for your family, open up an IRA or a beneficiary account and invest and designate those people as the beneficiaries.
Eric, there was a question about annuities, and this from Barry. Is there ever a good reason to buy one?
Good question, Barry. I've been trying to figure out a good reason for 10 years, and I honestly can't. And I'm not crapping on the annuity business. I'm not. I have clients who come to annuities, and I'm often their CIO, the quarterback, if you will, on their whole estate. And I get in there with annuity salesmen, and first of all, it's 6% up front for an annuity. So that's as expensive as the buy and sell the transaction. So if you get a $100,000 annuity, they're taking $6,000 at least off the bat. So only $94,000 to get invested. The way the annuity contract works is they're banking that their tables to know when you die are better than your knowledge. And they're trying to sell fear. So it's an informational advantage on their end, saying, I know when you're going to die better than you know when you're going to die. So if you turn over all of your money, you think you're going to live to 100, and we're selling fear, thinking you're going to live to 100 and we're going to keep paying you every single month, saying an immediate annuity. We know you're actually going to die at 67.5, especially given your risk. So we just made $30,000 off that policy, in addition to the $6,000 you gave us, because at $100,000, you're never seeing it again. So I know that sounds a little bit crass, but the way the annuity works, you turn over the money to the insurance company, not an investment company, an insurance company, and your heirs don't get to see it. That is now removed from your estate. If you die, if I buy a $100,000 annuity today, I turn that money over today, I die tomorrow, the $100,000 gone. That's how they make their money. So sure, if you have great genes and longevity, and you think you're going to live to 120, and you don't have enough money, and you think you can outsmart the insurance company, buy the annuity. You'll win that trade, but 9 times out of 10, the insurance company's smarter than me and most of us, and they're going to win that trade. And that's why they've been around a long time.
Excellent. There was a question that just came in, but we're running short on time, so maybe we can get back to them offline. Eric, appreciate you taking the time today to entertain and educate. I was going to say this event was brought to you by, pick your insurance company, but I don't think they'd want to be sponsored by you.
Insurance all day long. They can.
So just as a follow-up, Mac will be sending everyone links to the calculator, to the slides, and you'll have access to that as well as the recording. I want to thank you, Eric, again for your time and your insights. The final session that Eric will be hosting will be on April 30th at 1 o'clock. We will send a link to that so you have it and you can register. Until then, I wish everyone a great day. Have a great week, and we'll speak to you soon.